Yo, what's up, guys? I just found one of the most impressive dividend growth stocks that I've literally ever seen. And I can't wait to share with you this stock. And before I show you the ticker symbol and the company name, let me just show you the dividend history of this company. So, right now, they have a pretty low dividend yield and they pay 25 cents a quarter. But look at this special dividend if you notice. They just paid a $20 special dividend. In the year before, a $15 special dividend. In the year before, another $15 special dividend. So right now, this company has a literal 3% payout ratio. So the yield right now, when you don't include the special dividend, is only 0.29%. So literally nothing, I get it. But when you include the special dividend, their yield starts to jump up a bunch. So the company I'm talking about is ticker symbol DDS or Dillards. Let me show you the stock price of this. So this company has exploded, like it's better than Costco, Walmart in terms of stock price appreciation. So this was the 2020 dip. In 2020, they fell down to 18 bucks, and today they're at $343 per share. And I'm about to show you why. And look at the forward PE ratio. It's literally a 10.18. So the valuation, in my opinion, still makes sense, even though it's at all-time highs. So look at this. This is their net income right here. And look at the year-over-year numbers. It is down year-over-year. But let's compare this to 2020 and 2019. It was very inconsistent, sometimes losing money, but then they started cranking out this net income. So they made $180 million in net income. Down here in free cash flow, they made $244 million. But let's look at net income for this because they are a retailer. So look, they made $180 million. How much do you think their dividend cost them? So their dividend only cost $4 million a quarter. So that's why they literally have a 3% payout ratio when you do the trailing 12 months net income. But look at this. Why does it say negative $328 million? That's when they did the $20 special dividend. And why these are all the special dividends that they do. So remember, they made $150 or $160 million just this quarter. That pays for half of the special dividends. So if they wanted to, they could afford a $10 special dividend. But since they're not doing many special dividends, look at the stock buybacks that they're doing. So they never issue stock. They're always buying back their own stock. So that's why the company appreciates its stock price a bunch to the point where you now own 1.52% more of the company than you did 1 year ago. You can literally see the shares outstanding just go down over time. They used to have 30 million shares outstanding, and here we're almost half that. Just in 4 years, they've nearly bought back over half the company. So that's what's insane about this company. And look at the interest that they're making. So let me show you their cash position. They have $817 million of cash right now. So $817 million of cash and only $520 million of total debt. So they have a lot more cash than debt. And because of that and the high interest rate environment, this company is making a bunch of interest. They used to pay $10 million in interest from their debt. Now their cash, since they have way more cash, they put that in the high interest yields. They make more interest than they pay in interest. So that's always a great sign of the company. So that's what I wanted to share with you. Do be aware that the net income is declining, these year-over-year declining numbers. So their margins have been getting a little hit. Of course, I always recommend you go and do your own research, but you can't make up this stock price appreciation. But even now, the valuation kind of makes sense, 10 forward PE ratio, and you're going to get more special dividends, and they're going to organically grow their 0.29% dividend because they have a 3% payout ratio. So when I say they have room to like 5x their dividend, they really do. Let me go and show you proof that they actually have a very low payout ratio. So let me go ahead. So it's ticker symbol DDS. Remember the market cap of this company. It's only $6 billion or 5.57 billion. But look at this. Look at this payout ratio. It's a 2.46%. It's literally their dividends, their annual dividend per share divided by their EPS, and literally a 2.46% payout ratio, though the yield is 0.29%, not including the special dividends. And check out the free cash flow of this company. So in the trailing 12 months, they have operating cash flow of 600 million, and then you subtract the capex, and that's how you get the free cash flow. And then you put this on a per share basis, you have $32 per share of free cash flow. And then we're going to do a multiple on this. Let's see what 10 is. So if they're trading at 10 times free cash flow, that's a $320 stock price. And today it's $344. So they're trading exactly at 11 times free cash flow. So, still to me, that's a reasonable valuation, not personalized advice. And this company also has 11 years of dividend growth. So they're going to easily be able to keep raising their dividend because I've never seen a company with such a low payout ratio. But again, the yield is only 0.3%, but that's like That's if you double this to a point 0.6, that would be a 5% payout ratio. That's the same yield as Apple and a way lower payout ratio. And here are really the risks of this company. They have a low market cap of $5.58 billion. They're in an industry that not a lot of people love. They're retailers, though they seem to do it right. And they also are close to all-time highs, although all-time highs were 470 bucks. Actually, we're over $100 off all-time highs. So hey, maybe now's a good time to dollar cost average. You do get those special dividends. They can easily afford those special dividends. So that's a really good thing. Their dividends not going to get cut. But let me quickly show you how my portfolio is doing today. We're barely break even or down 0.08%. Looks like the REITs just keep going up. McDonald's is kind of a mini REITs. Over $50 billion of their market cap is the real estate. They collect royalties and fees from all their tenants. So check this out. Here's realty income. I'm super impressed with realty income. Look at this 3-month chart. They're up 18% the past 3 months. We're up over 20% on our realty income shares. That's actually unbelievable. Congrats to everyone holding REITs. And also McDonald's has done insanely well. We're up 18% on McDonald's. So here, let me show you my total percentage change from every single stock. Actually, check out my previous video for a complete and total stock portfolio update. We also have Salesforce earnings. That's the last thing I want to go over in this video if you're curious. So Salesforce reports earnings. This company is actually 12%, or it's my second largest holding. Salesforce is a huge holding for me. And let me show you why I really like this company. So it doesn't attract a lot of investors right now because people look at the PE trailing 12 months. It's a 27 trailing 12 months PE ratio, but a 26 forward PE ratio seems pretty reasonable for the amount of growth that they're doing. This company actually makes more free cash flow than Coca-Cola does. But check this out. They made $6.25 billion of free cash flow in the most recent quarter. And that's the highest it's ever been ever. And it was up 39% year over year. So that's one of the huge, insane highlights about the company. Also, let me show you their net income growth. Look, they used to lose net income or, barely make any net income. Look at this. They started to crank out this net income, which I love. They have a very healthy balance sheet. They have more cash than debt, so they could pay off all of their debt right now if they wanted to, but they're not. Let me show you the stock buybacks that they're doing. So they also just started paying a dividend. That dividend only cost $388 million. Remember, they made $6 billion in free cash flow. They have so much room to raise the dividend that look how much they're spending on stock buybacks every single quarter. So look, this is when a lot of people hated Salesforce. They're always issuing stock. Now they're like, all right, we're going to focus on investor returns. They started buying back tons of stock. So when they just announced a dividend and they're doing stock buybacks. That's what I love about the company. And also, they have $9.96 billion of cash. So we'll call it $10 billion of cash, even after doing the dividends and stock buybacks. So remember that $10 billion of cash and total long-term debt, which is the nasty stuff, of $8.43 billion, which is down 10% year over year. So they're paying off their debt. And because of that, let's see the interest. They should be making a lot of interest. I haven't checked out that actually. Oh my goodness, they made $167 million of interest in the most recent quarter, $76 million in the quarter before that. Look, they used to pay interest. Oh, actually, they were making interest back in 2022. But anyway, good sign to see that they're making interest off their cash, which is what I expected. Their retained earnings is it's up 65% year over year. So this is what I love about Salesforce. They're a very profitable software as a service company. And I can't wait to see what their net income number is, see how much net income they make. Our average cost basis is $244, and we're up 7.86%. So yeah, let me know your predictions for Salesforce stock in the comments. I'll make sure to look at every single one of the comments. And don't forget to drop a like on the video, and let me know your thoughts on Dillard's. I thought it was such a surprising stock. The amount of special dividends that they're doing, that super low payout ratio, no other stock I see is like that. So I always like sharing companies that I don't tell you to buy, but you can add them to your watch list because they're definitely interesting. But anyway, thank you guys so much for watching. Hope you guys have an amazing rest of your day. I'll see y'all next time.